Welcome to a deep dive analysis on the company Workhorse. This company has huge hype and shares have shot up 561% in just the last month. If you've watched my videos before, you know I take a detailed look at the numbers and data behind the companies I research. If you want to better understand the hype behind this company and whether it's worth buying, make sure you watch this video to the end. It is packed with data you don't want to miss. Before we get started, take a moment to like this video. These videos take me a ton of time to make and I would love to get it out to more people who are interested. Make sure you subscribe and hit the bell so you never miss a future video, and let's get started. When I say hype, I am not kidding. 561% in a single month would be shocking were it not for Tesla, Nikola, and Hyliion. Workhorse is up almost 20% just on the day I'm making this video and over 141% in just the past 5 days. So if you've never heard of this company before and did not know if I was being facetious about it being hyped, I think you can agree that's certainly the case now. So why are people so excited? A huge piece is that this is an electric vehicle company and people have been buying up Tesla, Nikola, and Hyliion, 3 other electric vehicle companies, at outrageous rates. Workhorse's services and products fall in 3 major categories. The first are electric delivery vans with a 100-mile range, the second are delivery drones, which are obviously pretty cool, and the third is their telematics, which is an integrated system used for tracking vehicles. As for the electric delivery trucks, they have 2 C-Series vehicles pictured here, the C650 and the C1000. They are 100% electric, and this connection to Tesla, Nikola, and Hyliion is undoubtedly part of the hype for this company right now. I say this because prior to Nikola and Hyliion's announced mergers and their share prices going parabolic, Workhorse had a low share price. Over time, Workhorse has made a number of improvements to their trucks, such as improving the battery packs and delivering a low-floor design which allows for easier access. They have a Metron app which can be used to track and monitor the Workhorse vehicles for a delivery fleet. Their Horsefly autonomous drones are intended to be used for delivery much like the trucks. It has its own app known as the Aries Delivery app, which allows for controlling and monitoring. It also has a real-time onboard video of Horsefly. Interestingly, the plan is for their electric delivery trucks to be the jumping off point for the drone, which will be paired and will meet back with the truck after the delivery is complete. The drone can fly fully autonomously. The drones can carry up to 23.6 pounds at max speed of 45 miles per hour. The cost to operate is only 3 cents per mile. Here's a look at the app, which in this case is showing where the Horsefly is located and how much longer before it brings its delivery. It allows for monitoring, video sharing, and easy delivery cancellation. The Metron app, as can be seen here, is intended to control a fleet of delivery trucks rather than a drone. It has an interactive map, allows for easy optimization of delivery routes, and can even track the charges of the electric vehicles. Workhorse sees significant market opportunity in the last mile delivery space, which is where they are focusing. This differentiates them from companies like Hyliion, which is focused on Class 8 trucks. Workhorse plans to focus on these smaller delivery trucks and drones for delivery. They note that over 350,000 last mile delivery vehicles like those pictured here are purchased just in the US every year, and a vehicle sells for around $50,000 on average. The market for these vehicles is around $18 billion per year. Workhorse believes that they have a great opportunity there. A sample of customers they would like to have includes companies like Amazon and Walmart. Pictured at the bottom are 4 of their C models. They note that their fuel efficiency will give companies considerable savings over time. Here they show $170,000 in savings by the 20th year of operation for a vehicle. You can see at the beginning of this graph that the fuel efficiency should allow the higher initial cost of these trucks to break even around the 3rd year of operation. They see themselves as lining up well against other companies like Tesla, as they note Tesla is untested and has a lot of TBD or to be determined ratings here. Compared to many other companies, they feel that they are more durable, have a better design, greater cost efficiency, and less environmental impact. Obviously, they also have the integrated drone, which no one else has. There's been some important partnerships that you should be aware of. First, UPS has made 6 orders for 1,345 vehicles, although they began years ago, as you can see from the timeline. With USPS, they have built 6 prototype vehicles. They note that there is a 165,000 vehicle, $6.3 billion USPS contract opportunity. However, as for how likely this opportunity is, that remains unclear. At this point, they are a finalist for the contract, but it has yet to be awarded. Whether it is awarded or not will significantly impact the share price. Also know that they have a partnership with Lordstown Motors, which will license and manufacture an electric pickup truck which will compete with both Nikola and Tesla. So now we come to the big question. With those products and services and opportunity for the future, is the current share price justified? Is it an investment? Does a 20% increase on the day I made this video make sense? How about the 561% over the past month? Well, first, let me dial back the share price for you just a little bit farther. If you look back to 2016, you can see the price previously shot up and then plummeted. In fact, it dropped almost 95% and was a penny stock for years. That's not the most encouraging history, but we have to look at the numbers. What does the data tell us? Well, when we look at fast graphs at earnings, we see that they do not have any and never have in their more than a decade-long history. You can see they are not expected to have any next year, but may have some earnings at the end of 2022. They do not pay a dividend, of course, they have more debt than capital, and they do not have an S&P credit rating. To me, none of those are good signs. It is small with a market cap around $1 billion, but bear in mind it was only a couple $100 million just a month ago. Here we look at free cash flow and again see it has never had any positive free cash flow and none is expected in the near future. Now we look at earnings before interest, taxes, depreciation, and amortization. Still nothing and none expected. Also, just for a moment, look at how insane this price increase is. Obviously, in terms of present value, nothing justifies that, but let's continue our investigation. Here we are looking at their negative earnings per share. Although their earnings are closer to zero than in the past, they remain negative. Here we can see free cash flow is also negative and has actually gotten progressively more negative across the last 6 quarters. I can't tell you their price to free cash flow or price to earnings ratio because their free cash flow and earnings are negative. Looking at sales, we see that the sales per share have actually decreased dramatically across recent quarters down to nearly nothing. Although this is of course in part related to the global crisis for the most recent 2 quarters. The current economic crisis does not explain why it was decreasing in sales throughout 2017, 2018, and 2019. Further, according to Fidelity, its sales decline for this quarter is so significant that its sales growth is only at the 3rd percentile for its industry. This means other similar companies have fared far better. The share price spike when combined with nearly nothing in sales gave us a price to sales ratio of 14,460. That's a pretty crazy number, but not in a way I want to see it. The decline in free cash flow and sales is also not positive to me, even if there is hope for improvements in the future. If we look at Fidelity data, most of it is incomplete for valuation. This is because it could not calculate price to earnings with negative earnings or price to book with negative book value. Because Fidelity updated on a different day, the price to sales is an incredible 10,055. Margins are negative and returns are a staggering mix with return on investment at negative 203%, yet return on equity at 85%. Fidelity's S&P Global Market Intelligence rated the valuation, quality, and financial health as quite poor, though growth stability was seen favorably. The company has a negative interest coverage ratio and negative short-term debt coverage ratio. The quick ratio and current ratio are both well below 1. What does this tell us? The company is not particularly financially healthy and could struggle to cover their debt and interest in the future. Again, this is not what I look for. You could argue it has looked far worse in the past, but the fact that their interest coverage has never been positive in the last 5 years is not what I look for in investments. So what is the conclusion? Well, there is no historical or current rationale for the current valuation. The share price is baseless. So why is it high? Well, there's 2 parts. First, it is similar to other very overhyped stocks which have shot up in share price. People want to cash in on something similar to Nikola or Hyliion with Workhorse without doing their research to see whether the opportunities are truly similar. The second part is there are people who truly have researched this company and do see genuine opportunity and believe it is on the cusp of big contracts and growth which they want to cash in on. Workhorse just announced it is joining the Russell 3000 Index and its delivery vans just passed the Federal Motor Vehicle Safety Standards testing. Those are good signs, so is it worth a gamble? Well, as a buy and hold investor, I don't gamble. As you may recall from fast graphs, the analysts did not expect positive free cash flow, EBITDA, or earnings for years. That does not give the growth I am looking for. Looking at Finbox, we see analyst forecasts for earnings per share in purple. You can see earnings are expected to be negative until the end of 2022, similar to fast graphs' prediction. Even then, earnings per share are only expected to be 15 cents per share by 2025. At the moment I am making this video, the share price is $17.39. That means if I had bought today and held until 2025 when it hits 15 cents in earnings per share, assuming that happens, I would have waited for 5 years to own a company with a PE of 116 based on my initial purchase price. You can guess my thoughts on that. Looking at funds from operation, these are negative and are expected to become even more so over time. While FFO, or funds from operations, is expected to become positive, this will not occur until December of 2022 based on forecasts and may actually decrease into 2025. If I am paying a lot for a growth story, this is not it. Now let's take a look at revenue and EBITDA. Here we can see the revenue in purple is positive at $20 million and is expected to grow steadily to $600 million by 2025. That's good to see, but the poor earnings and cash flow are not enough for me. Also bear in mind, this company has been public since 2010. To just now begin to make any revenue and still be waiting on earnings does not impress me. Hyliion, which is not yet public, is expected to be profitable next year. Hyliion is also projected to have higher revenue than this and over a year sooner. Again, that is Hyliion, which is not even public yet. The question for me then is why I would invest $1 into Workhorse that could be invested into Hyliion. Taking a look at EBITDA at the bottom, it is negative but should become positive sometime in 2022. So what does this tell me? For me, the history does not impress. The present numbers are not exceptional. Even the future numbers are disappointing. Plenty of other companies have far better investment opportunities. If I wanted to invest in electric companies, I would invest in Hyliion instead. This is not to say that some of you won't make money on Workhorse. I know some of you will, and many of you already have. However, I am not a day trader, nor am I a speculator and gambler. It is not my style, so I won't be buying Workhorse. What are your thoughts? Is Workhorse worth buying? Is it all hype? Will it get that USPS contract? Leave your thoughts in the comments below. I look forward to hearing from you. Don't forget to subscribe and hit the bell so you never miss a future video. As always, good luck with your investing.